Welcome to Lunch Money. Coming up, what next for buy-to-let as landlords struggle? Is the tie-up with M&S paying off for Ricardo? And stick around to find out why house prices are now forecast to rise rather than fall. Hello, I'm Simon Lambert. Joining me on today's Lunch Money is This Is Money's Helen Crane and Richard Hunter from the show sponsor Interactive Investor. Helen, buy-to-let landlords haven't had it easy in recent years as it's become much less tax-friendly, regulation has increased, but the real blow has come over the last 18 months as mortgage rates have suddenly gone up substantially. The good news is that they've come down recently, which we'll get on to shortly, but first, let's paint the picture. What's happened to buy-to-let? Why has it got much tougher?
Yeah, so this all started in 2016 when the government brought in a new stamp duty surcharge. So that meant that if you're buying a second home or if you're a landlord, you have to pay an extra 3% in tax when you buy that second property. There's also been changes to the way that landlords can offset their mortgage interest against tax. They used to be able to do that. It's now not so easy. They find that they're paying more taxes on in general across their sort of rental portfolio. Capital gains tax changes, that's one that's come more recently. It's now, if you're a landlord and you sell a property and you make a profit, you're likely to be much more sort of hammered by tax. And also more regulations. So we've got things like the Renters Reform Bill. That's not quite passed yet, but it's going through Parliament, and that's probably going to make it easier for tenants to challenge landlords on things like substandard homes. It's also going to make it, for a lot of landlords, more difficult to evict their tenants if something goes wrong. So more kind of admin and potentially making it more difficult to get your property back if you're not happy with your tenants. So, you know, good for tenants, for landlords, brings up quite a lot of potential sort of worries.
So we've moved from a situation where people were actively being encouraged to become landlords. I mean, that was why buy-to-let was actually set up in the first place, to a point where we're trying to discourage them. We're hitting them with extra taxes when they buy, we're hitting them with more tax on their mortgage and then tightening up the regulation. Has this affected the number of people wanting to get into buy-to-let?
Yeah, it has, and we've definitely seen that across the last few years. So, you know, it's hard to make a profit. There's a lot more kind of hassle and admin. So, according to Hamptons, there's landlords have sold almost 300,000 more properties than they've bought, and that is since 2016. So, yeah, the amount of rental properties owned by landlords in the market, it is reducing. You know, landlords are selling up and new ones aren't necessarily coming in to buy those properties, and that's why we're seeing rents go up so much. You know, that's been a real trend for many years. I think in the last 2 years, according to HomeLet, rents on a newly let property have gone up by 20%. So, you know, it's the two sides of the story. Although there are these new regulations on landlords, they are paying more tax. Rents have also consistently gone up and up and up. So, you know, their profits are being hit, but rents are still consistently rising.
And the less people buying is theoretically good news for first-time buyers, perhaps, and perhaps even landlords selling up is good news for first-time buyers if they can go and buy those properties?
Yeah, potentially. You know, those kind of properties that might be rented out to, you know, to house sharers could be a nice property for a first-time buyer. Landlords also have the benefit of, you know, they don't have an onward chain. First-time buyers don't have an onward chain, so that could be quite a nice kind of deal to be done for both of them, I suppose. And yeah, if landlords are keen to sell, if they're finding, as you say, with mortgage rates having gone up, their profits are being really hammered, they might be keen to sell quite quickly, and they might be sort of willing to cut the price in the way that a homeowner who has an onward purchase to make perhaps might not. So yeah, it could be a potential window for first-time buyers.
And we have seen residential mortgage rates cut, and we're seeing buy-to-let mortgage rates cut as well. How big have the cuts been, and how do those rates now compare to what rates looked like a couple of years ago?
Yeah, so in the last couple of weeks since the start of the year, we've seen mortgages cut by almost all of the major lenders, and that's across residential and buy-to-let. That's on the back of sort of more positive forecasts about where the base rate might go this year. So buy-to-let specifically, the best rates on a 5-year fix are about 4.10, 4.15%. So that's looking quite a lot better than it was a few months ago when they were going up, past 6% in some cases. The average rates are a bit lower than that. Obviously, those best rates are for people who have, the highest amounts of equity to put in. The average on a buy-to-let is about 5.7%. So still much, much higher than we were seeing, a couple of years ago when they could be really, sort of 2-3%. But they are kind of moving in the right direction.
And because most buy-to-let mortgages are interest only, although the actual monthly payments on them are lower, the impact of those higher mortgage rates is greater, isn't it?
Yeah, exactly. So if you're on an interest-only mortgage, if your interest rate doubles, that's your monthly payments also double. So that's how landlords get into this situation where they feel it more sort of intensely than maybe a homeowner who would be chipping away at the value of their mortgage as a whole.
Okay, Helen, thank you very much. In today's business news, Ocado has revealed the latest update on its joint venture with M&S. Richard, after a good start for Ocado Retail, it's not all been plain sailing. How is it doing now?
Yeah, you're absolutely right. And it's important to make that distinction at the top that today's trading statement was from Ocado Retail. And that is basically the 50-50 joint venture with Marks and Spencer. So it doesn't include the rest of the Ocado business, which obviously factors into the share price, rather just the joint venture. And in answer to the question, they've had a particularly good quarter, culminating in an extremely strong record sales figures over the Christmas period, which has obviously lifted the numbers for the year as a whole. So in terms of an update, it's been taken very positively. The shares are currently up just over 7% this morning. They've been as high as over 8%. But again, set against that is the more recent share price performance and the fact that we're not looking at the business as a whole.
Now, we're keenly watching the results from the food retailers for information about prices, inflation, and also what are people buying and whether that's changing. What has Ocado told us about that today?
Yeah, I mean, obviously those trends tend to be, the water tends to be muddied around the festive period when people, needless to say, make those additional purchases food-wise that wouldn't normally be the case. But I think if there's one theme that's been the case more than any other over the course of the year, it's that the ferocity of competition in the supermarket grocery sector is showing no signs of going away. Each of the supermarkets, of course, whenever we hear from them, is saying how its prices are competitive compared to others. And Ocado, which isn't traditionally associated with being that sort of middle of the market range, has its own Ocado price promise. So it's clearly mindful that we're looking at extremely cost conscious consumers. Although inflation is on a downward trend at the moment, particularly food inflation, it nonetheless remains high. So each of the supermarkets, and we heard this from Ocado Retail today, has been able to pass on an element of price increases, just not to the extent of the overarching food inflation figure. So that being said, there's no question that Ocado remains relevant. Clearly, its tie-up with M&S means that it's got good 90% coverage of M&S products in terms of the food ranges. And as we heard from M&S last week, they also have had a particularly successful festive season, which Ocado Retail has been able to some extent, ride the wave of.
Yes, obviously M&S is a big part of this, and when Ocado switched from working with Waitrose to M&S, it was big news. Has this partnership been good for M&S?
Well, they're back into earnings growth. They're earnings positive, which is usually shorthand for not necessarily sustained profitability. There was a quote coming out of Marks and Spencer earlier that we could be looking 3 years away from full profitability for this venture, as opposed to the next 1 or 2 years. And of course, that also feeds into one of the reasons why the Ocado share price as a whole has tended to suffer, because the solutions business, the famous robotics in their warehouses, which are basically fulfilling orders for not only Ocado but for other retailers as well, has yet to live up to its billing. So a share price at the moment, which is around 660-ish, was in September 2020 over £28. So that's some indication of how far this particular star has fallen, and the fact that it's because of the lack of progress on the solutions business, not the part we heard from today. It's becoming regarded, unfortunately, as something of a jam tomorrow stock.
Thank you, Richard. Yes, online retail, probably better for the consumer than it is for the people selling it to you. And finally, back to the property market. Last year saw a swathe of gloomy house price predictions as the rise in mortgage rates hammered home buyers, Helen. But we've seen a bit of a change around. A major estate agent has changed its tune completely, and it's gone from suggesting prices are going to fall to prices are going to rise. Who said this, and what have they been saying?
Yeah, so they've changed their tune, and they've changed their tune in a very short amount of time. So this is Knight Frank. Back in October, only 3 months ago, they predicted that by the end of 2024, house prices would fall by 4%. This week, they've now completely turned around on that, and they've said that house prices are going to go up 3% by the end of 2024. And that's off the back of predictions about where the base rate is going to go this year. So there's analysts are forecasting there's going to be more cuts in the base rate. Inflation is going down, perhaps a bit faster than expected. That's going to, they think, bring mortgage rates down, and that's going to inject a bit more confidence and a bit more sort of movement into the housing market.
Okay, thank you very much. That's all for today's Lunch Money. You can catch all the previous shows by searching for This Is Money on YouTube. And if you're watching there, please do us a favour and hit the like button and the subscribe button. Or come to thisismoney.co.uk/lunchmoney to find all episodes past. And join us for our next show on Thursday. Goodbye.